morning, everybody, or good afternoon, depending on where you're located. My name is Kyle Orwick. I am a partner in our transaction advisory services team in Minneapolis. I started with Eide Bailly about 12 years ago in the audit department. From 2011 to 2014, I actually was living in Germany, working for an accounting firm over there, working on mid-market transactions in the M&A area. And in 2014, I came back to Eide Bailly and with the idea to kind of start a due diligence and quality of earnings practice within Eide Bailly. We have 7 full-time people in that team now, and we work primarily on deals in enterprise value or revenue sizes, basically 5 million to 250 million. We cover a broad range of industries, but those include manufacturing and distribution businesses, consumer products, business services, technology, professional services, and construction and engineering companies. I'll turn it over to Frank to introduce himself.
Hello, everybody. Can you guys hear me? All right, Kyle.
Yep.
All right. My name is Frank Donati. I'm a senior manager in our Denver office. I've been with the firm for about 10 years. The last 4 have been spent exclusively with the transaction advisory practice. My background before that was in audit. During the time, as Kyle mentioned, we have a pretty diverse practice. I've kind of touched them all, mostly manufacturing, construction, but I do have experience in nonprofit and also just other general commercial businesses.
So just a kind of an outline or overview of the topics we'll talk about this morning, just various roles and who are the players in an M&A deal or an acquisition or a sell side process. What are the areas that really drive value other than just size of the business or industry? And then in the M&A cycle, what's the timeline look like? When are people doing what timeline we kind of primarily focus in on with due diligence. And then we'll kind of give some due diligence overview of what types of due diligence there are, as well as specific examples of financial due diligence efforts. The elephant in the room, obviously at the time right now, is COVID-19 and the impacts on deals. What you can be doing from a due diligence side there, either on a sell side process or a buy side process. This presentation is more general to due diligence itself, but we'll have considerations in there specific to COVID-19. Thinking about trying to do a more specific presentation on COVID-19 once we get towards maybe the later parts of the pandemic. So it won't be the primary focus of this presentation, but we'll definitely touch on it. And then we'll talk a little bit about anything you do find during sell-side preemptive due diligence or buy-side due diligence, how you can kind of overcome those hurdles. First, we'll basically touch on high-level sell-side considerations that management should make while they're contemplating going to market. Keep in mind that, and Frank will have a similar slide on buy-side considerations, but the general idea is from a sell side, you want to make sure it's similar to if you were selling your house, that things look good or functioning well. You're trying to maximize value and functionality of that house, and in this case, a business, to make sure you get the most value out of it. In this case, when you're trying to sell a business, one-time events or normalizations could be things that have happened in the past that are impacting the financials that are not expected to be going forward. Could be fines, insurance gains, any types of lawsuits that are not normal for the business. But I would also throw into this bucket any types of discontinued segments or operations, any carve-outs of those. And then, basically if you are a construction business and you stop doing electrical work because you lost a lot of money at it, and if you can prove that you no longer do those types of contracts, you might be able to carve out those activities to show a buyer what the business is more realistically going forward. As well as in this area, any soft gains for kind of accounting process changes or soft losses if you started accruing wages in 2020, that's going to negatively impact your P&L. And what would it look like in a more normal case, closer in accordance with GAAP across all periods? So kind of a long-winded answer on what is all included in one-time events and normalizations, and Frank will provide kind of more specifics on that later. But also, so EBITDA is a main consideration, and that's earnings before interest, taxes, depreciation, and amortization. I've heard a really funny term recently called EBITDA that also adds on COVID at the end. Some COVID humor, if there's such a thing. But working capital is another. So EBITDA is a main consideration for selling a business, but I would argue that working capital is also a main deal driver, and managing that working capital to be as lean as possible leading up to a transaction is important. So you don't, the buyer's going to expect you to try to deliver as much working capital that you've had in the past. So lowering that hurdle is beneficial to the seller. Discretionary expenses, these can be a broad range of things. We've seen fishing trips and vacations, personal vehicles being expensed through. Some other types of discretionary items sometimes are bonuses that are really one-off. During the, when there was the tax reform, we saw a lot of people give kind of one-time bonuses, and some people considered those discretionary because they wouldn't happen all the time or every year. And then another one I saw recently was somebody worked for a company that gave him a Corvette, like $100,000 Corvette when he retired. That would probably be considered discretionary unless there was some sort of a requirement to do so. So just some examples of areas sellers should look at their P&L and balance sheet to make sure it's kind of what a seller or what a buyer can expect in the future. Market comp, or market rate compensation, or rent. Rent is an easy example where if you own the building but you're not going to sell the building, what is the fair market value of renting that facility, and how does that impact EBITDA? Similar with what owners pay themselves as part of the management team. One of the areas Frank will touch on with deal value for sellers is what does that management team look like post acquisition. And certain companies want to, so if it's a strategic buyer, a company buying another company, sometimes they'll reduce some of the management team and take it in-house. If it's private equity, they really search for companies that are, it depends on the private equity group, but the highest value payers are usually ones that are looking for companies that have full management teams that will be retained. So kind of beefing up the management team is a good consideration. And then technology, and how scalable is the technology to where the growth plan looks. So those are all just areas that a seller might want to consider pre going to market.
Sure. So as Kyle mentioned, there's several things on the buyer considerations that are similar to what we do on the sell side. We do emphasize a few other areas that we wanted to bring up on this presentation. First being concentration risk. A lot of what we'll look at on a buy side due diligence is any customer dependencies, product dependencies, geographic dependencies. And with that understanding, has there been any changes to those relationships or any concerns? Post-close, will you have that same relationship with the top customer, or will you have geographic goals that might not align with what they were doing before? Kyle kind of touched on one-time revenue and expenses and normalizations. I think, as he was mentioning, COVID is going to fall into this bucket. What's important to remember is we're all worrying about the businesses that haven't done well, but with one-time revenue and expenses, we also have to think about the businesses that maybe have changed what they've been doing specifically to capitalize on the availability, such as I saw the other day, a fashion brand has switched over to creating masks rather than retail store apparel. So we'll be looking at that in both directions when we go to do buy-side due diligence. Furthermore, we'd be looking at backlog, what business is coming up. I think the question we're getting a lot on our construction and engineering jobs right now is the backlog still going to be there? Is it going to be stretched out further into the future, or is it planning to start on time, or is it going to disappear altogether? So that's something we normally look at, especially right now with some of the funding scarcities that they have. It's definitely becoming a bigger question. And then furthermore, sales and purchase commitments. Has management who's selling committed to a purchase or a sale at what cost, just to make sure somebody isn't inheriting something that's not profitable or going to have to spend $1 million on a customized machine they can't get out of post-close. Furthermore, you have a stock or asset purchase, and where this comes into play is understanding some of the legal and tax implications that can come from which type of deal you select. Typically on a buy side, due diligence engagement, if it were to be an asset purchase, we're not as concerned with tax liabilities. Should it be a stock purchase, we will more often than not recommend some sort of tax due diligence be performed. We could certainly do it on asset. There's a little less that applies, but such things as sales tax and use tax, making sure those are up to date, would fall under that bucket of both being relevant to stock and asset purchases. And then echo what Kyle mentioned on technology assessment. What we would do here is also make sure we evaluate the integration, whether it'll integrate with a buyer's current system, how much would it cost to integrate, and whether it can hold the capacity of where the buyer hopes to take this business in 5-10 years. So due diligence overview, there's several players involved in the diligence portion of a transaction. We figured we'd point out what we at Eide Bailly cover and then other typical advisors we come across. So financial due diligence, that's kind of Kyle and I's bread and butter. We look mostly at the accounting, gap compliance, normalization adjustments, understanding the financial statements as to whether there is any concern. Next, you would have operational due diligence. So typically what this would involve is industry experts, something as in the construction, depending on what construction you're doing, you may come in with somebody that you've hired to be part of your buy team to help run this. So having him go out there, understanding the business, where you could take it. Also including in this would be bookkeeping services, should you need some of the accounting backbone that they may not currently be investing in. Tax diligence, this is kind of what I was mentioning on the previous page. This could include accountants and attorneys, just understanding what a post-transaction structure for that entity may be, or your existing entity, how it may be affected by acquiring this. And then to technology due diligence, which we've kind of covered, or implementation of a new ERP that maybe comes and brings your existing business on board with the seller. And then other advisors we will typically come across is commercial due diligence, legal diligence, human resource diligence, and then environmental and insurance. That's not an exhaustive list. Those are the typical ones we come across, some more often than others. I would say on most deals, there's at least legal, HR, and insurance diligence. Some of the other ones will come up on specific deals.
So just to give a kind of a background as people are going through transactions, who the main advisors are, basically anybody can be a trusted advisor. That's probably on this list, or even a bank or other advisors. But in a typical transaction, we usually see that an investment banker, and there are all types of investment bankers or brokers out there, from Goldman to people helping sell gas stations or restaurants or different places. So that's a broad range of different types of intermediaries. But we usually see that those are the people that are kind of developing the plan, kind of giving some ideas around what the valuation could be giving some ideas around who the buyer universe is, who might want to actually buy that company, helping market that business, developing kind of those marketing materials, as well as the timeline looks like, helping negotiate the key terms. I kind of look at them as kind of the quarterback for selling that business, or the coach. And then you have kind of other players. You could have a valuation person involved. I think what we usually ask is, in this case, should there actually be a business valuation, a formal one being done? We typically try to steer clients maybe away from that, because that's kind of a more theoretical or middle of the road valuation, instead of, a company might be able to actually sell for top of market to the right buyer. You just have to find that buyer, and that's where that investment banker can play a better role. And then on the tax and accounting side, performing due diligence, understanding, what the baseline earnings are of that business or cash flow of that business, kind of setting the foundation for the value of that business, either from a sell side or from a buy side, and then the tax structuring and how that has implications on value and proceeds. is super important. And then finally, that legal advisor helping do the legal due diligence, as well as helping write that purchase agreement and negotiating the key terms and reps and warranties that are involved in that.
So deal value drivers, I mean, obviously there's a lot of intricacies that can go into this discussion. We chose some of the higher level discussions to talk about, but the two simple ways to increase value in a business is increasing cash flows or reducing risk reducing risk. Typically what we look at in increasing cash flow would be revenue growth, whether that is expanding in a new geography, new product line, finding additional customers to add to your customer base. We're looking for that to help drive that cash flow improvement. Next, you have margin improvement, which would hopefully be both gross margin and overall EBITDA margin, which dives into a little bit of the overhead reduction, managing operating costs, seeing where there may be some excess that you can cut back on that would drive that cash flow up. And then you also have ratio improvement. So really taking a look at days in inventory, receivables and payables outstanding. Some companies don't watch that as closely, but when you go out to a transaction, that's one of the identifiers they'll look for to see, are they managing their cash flows? Are they paying vendors on time? Are they paying right when they receive an invoice? Are they waiting for their terms? Same on the receivables. How quickly are they going after delinquent accounts? So improvements there when you're, especially on the sell side, that's why we'll talk a little bit about deal timing, but the sooner we can get involved, the sooner we could talk to you about maybe ways to improve those ratios to look better once you finally get to market. And then the next part is reduced risk or reducing risk. Kyle talked about it a little bit, diversifying the management team. What this is targeted at is when you have one key individual in management or one sales officer who handles all sales, the risk of losing that individual, be it through the transaction, ownership transition, or just time passing, helping diversify that so it's not all falling onto one person. So if that person should leave, you could have a serious hit to your business or your the business you're purchasing. And then next is just process improvement. Is there any excess you can cut back to help with those operating and overhead costs or improve margin by becoming more efficient with that?
Thanks, Frank. One extra point I would make on the days inventory, receivables and payables, and how it impacts value. So there's certain businesses actually have negative working capital, and you would think, geez, if they have extra liabilities for deferred revenue compared to their AR or their assets on the balance sheet, they're kind of an upside down balance sheet. And if it's the right size business and it's the right type of business, those companies are actually worth more than businesses that are working capital heavy, because you can scale those businesses. I've heard the term infinite growth or infinite value drivers for businesses that have really low or negative working capital. So just concentrating on, I think that helps drive kind of the point home on how working capital really impacts kind of deal value.
And an extreme example to that from an industry perspective is hotel and tourism, airlines specifically, where you're taking payments up front. You have the cash in hand and you need to then deliver the service rather than the other way around.
All right. So we do have a number of advisors on the conference today. So just wanted to give an overview of, when somebody's helping you do due diligence, financial due diligence specifically, or tax diligence, what's regulating that process. And won't spend a lot of time on this, but kind of also contrasts a little bit of the difference between what you get out of an audit versus what do you get out of quality of earnings and due diligence. So audit is a pretty rigid process, has to follow the test standards, and it's really geared towards providing an opinion on the financial statements that's really GAAP focused and historical focused. Usually it's based on a fiscal year, and versus quality of earnings and due diligence, utilizing the consulting standards, can be more current data, can look at a lot more in-depth details. It can get outside the GAAP box and focus more on normalizing EBITDA and really cash flow focused. and earnings focused, kind of what the split of various types of revenue mixes are, and understanding the business more from an operational side. And then, there's a little bit more judgment involved in that than pure GAAP. And it's kind of more on a forward-looking basis, and it's kind of like an audit-like service for the purposes of a transaction, and getting assurance or getting comfortable at least over the financials and the investment that a bank is underwriting, and somebody's making a big purchase in. So it's not total assurance in the sense of audit standards, but it does provide comfort over what a company is buying.
So the next question may be, at what stage is diligence appropriate? And there's two separate answers. The first is for buy-side due diligence. Typically, we would advise to start consulting with external consultants and evaluating proposals during your LOI negotiation or letter of intent negotiation. Once you sign a letter of intent, typical terms are anywhere from 45 to 60 days that you may have exclusivity. So it's really important to hit the ground running as soon as the ink dries on that LOI. Sell side diligence is a little different. The quality of earnings we would typically try to get involved in earlier, say 6 to 12 months, with the idea being really getting to understand the business, understanding adjustments that could be proposed for a quality of earnings. And then furthermore, any improvements that can maybe be made in the short term heading to market that we could show were easy improvements so a buyer will buy off on them. It's a lot harder to sell, well, you could do this without proving it. And if we get in there soon enough to identify those issues, you might be able to start that process of proving it to a buyer where they're going to buy on or agree with kind of the proposed changes that might be able to happen and prove that they can actually be successful.
So kind of here's a Gantt chart of the whole process around selling a business, from a mid-market business that could last anywhere from 10 million of enterprise value up to 100 million, 200 million. Investment bankers are doing this type of Gantt chart generally, and we've kind of sprinkled in where we and highlighted where we come into play with either sell side quality of earnings and a quick refresh of that sell side quality of earnings on the sell side, as well as doing buy side due diligence. Generally, a really, really well-run process could take 22 weeks. That's assuming there's no major hiccups involved. So just it's always important for sellers to understand that it's a long process, and it should be to maximize the value of that business. So just some overview. We've touched on a little bit of this, but a little bit more in depth, and we'll give some examples of some of these in a little bit, specifically on EBITDA adjustments, and really you're trying to focus on what's going to be acceptable to a buyer, and you just throwing in random EBITDA adjustments that are very fluffy and not concrete doesn't do a lot of good and creates a lot of confusion. But ones that can be quantified and have supporting documentation around what's a true EBITDA adjustment, and Frank will provide some examples in a little bit, showing a bridge between kind of reported EBITDA per the financial statements and the definition and adjusted EBITDA. But there's certain things that kind of can work and certain things that don't. And it's kind of a gray area. There is black, white, and gray, I would say, in that category. And then on the working capital side, if there's any type of adjustments to EBITDA and earnings, is there a working capital implication that should be also considered? Or is there any other changes in the business that are occurring that it would impact working capital? Recently, we had a telecom business that extended terms, from I think 60 days to 120 days, which is pretty crazy. But we don't know if that's a short-term change or a long-term change, but it's certainly going to impact working capital and what the investment in the working capital is going to look like. Debt-like items, basically, who's going to assume the liabilities that are on the financial statements, whether it's leases or another gray area could be credit cards. Is it working capital or is it debt? Various theories on those items. And then what else do you look for? You can look at the balance sheet, you can look at the P&L, but is there any off balance sheet liabilities that could come back and get you? You want to look at those for due diligence. It could be operating leases that should have been finance leases, or even operating leases that are operating leases. Those are commitments that a buyer is going to assume. Is there any expenses that are, being paid in cash, or is there, is there any other entities out there that are related parties that are absorbing some of the expenses or some of the revenues? So kind of what else is out there that you're not seeing is important to try to ask some questions around. And then is there any tax risks that you should be, you are assuming if you're doing a stock deal, and what is the significance of those, especially in, federal, state, but also state and local is really become a main topic that we see specific risks. Quality of forecasting, when a business is on the upper end of kind of the above 50 or $100 million value range, if they are accurate, if they can accurately forecast the business and have a long backlog, and they can justify why they're going to meet their growth targets, sometimes that business will trade for some type of forecast. It could be because the process is going to take 6 or 9 months to complete the transaction, or it could be even longer, or if there's significant growth and they can really justify what that forecast looks like, it has to be pretty concrete, usually. And all of this is trying to deal with either value or other risks to deal with in the purchase agreement.
All right, so as Kyle mentioned, we're going to go through kind of some typical adjustments we'll see. These are by no means all exhaustive lists, but ones we do typically find. So kind of running through them high level. First thing we're going to look for is GAAP compliance. One of the things we're typically looking for is accruals appropriate. We're not, as Kyle mentioned, in the testing phase of an audit, but we will look for anything that's obvious, such as payroll not being accrued, vacation not accrued, maybe prepaid expenses, or sometimes when we do these mid-period or what we call trailing 12-month period ends, the company only has a hard close as of December 31st. So we're looking at June, trying to figure out what the accrual basis accounting should have been, using a different period end than what they're typically used to hard close on. Another thing we'll do with GAAP is if there is a new accounting pronouncement, if possible, if it was only applicable to the most current period, we may try and pro forma the previous periods so that we're comparing apples to apples over all periods under review. Next, we'll look at product and customer changes. So what we're typically looking for here is new products or discontinued products that may not be there going forward, whether they should be included as potential revenue in your cash flow projections going forward. If they've been discontinued, is unlikely, but there may be a reason for that product being discontinued. We've seen before with the customer side, has there been customer bankruptcies? If your top customer has gone bankrupt and is no longer there, how are you going to make up for that? And what's the changes to value caused by that missing sales? Then we have pro forma analysis. What this is typically in regards to is carve outs. So businesses that maybe have not always carved out their overhead between divisions, but you're buying division A, we're going to try and figure out what costs reasonably would go down to each division, usually through inquiries of management and just understanding what the expenses are driven by. Then we have non-recurring revenue gains and or expenses. So we talked about that a little bit before, but what typically gets included here would be transaction advisory costs. So our fee, any attorney fees, accounting fees, otherwise on the tax side that you're maybe incurring. Other typical one-times are insurance settlements, maybe a warehouse fire or lawsuits that aren't typical with the business. And then last, and Kyle spent a little bit of time on this early on, is the discretionary expenses that are incurred by maybe owners or management that are personal in nature, or they do an annual retreat to an island to talk about the business. Is that going to be there going forward? Should you purchase the business? Or if you're selling, should you be hurt on value because you know that's not going to continue going forward? We'd want to back that out. You want to go to the next slide, Kyle. So here's an example of some of these entries we're going to look for first. As I mentioned, typically the first step we go through is looking for GAAP and accrual-based adjustments. So in this case with inventory, I believe what happened was they switched from a FIFO to a weighted average cost system. So what we were trying to do was line them up and make sure we were truly comparing apples to apples across all periods. And then we had prepaid insurance and vacation accruals. The normalized adjustments, these are obviously a lot more broad. It kind of is looking at trends month over month and also inquiries with management, but they want to call attention to a couple of them. Number 4, so change in sales channel. I think that's going to be very relevant going forward. A lot of businesses who are maybe, let's say, clothing, selling through retail centers, that's probably shifting to a more e-commerce model. Maybe they're more profitable in that case. So how would it have looked had they stayed with the e-commerce method prior? And just looking at it again, so all periods are similar because it's no business stays the same year over year, but trying to understand where they're going by taking some of the fluctuations out. So then adjustment 6, officer compensation. This may be an owner who's paying himself below market for sweat equity. Maybe he's paying himself higher than market rather than through dividends. We're going to try and level that out because if the owner is only going to stick around for a year or if he's leaving after the transaction closes, what's his replacement going to cost and what would it look like historically? And similar applies to the rent expense where you have related party. A lot of times they're just paying off the mortgage on the other property that's in a different LLC. So what we'd be doing here is if we know that's the case, hey, does this line up with market, or when they sell the business, are they going to charge you a different rate now that you are a tenant and not a related party? And then just some other miscellaneous adjustments we've come across are listed in here. If you want to go to the next slide, Kyle.
Yeah, and just to point out, this type of table is kind of in a more broad quality of earnings report, has descriptions about what all each of the adjustments entails, how they were calculated, and what support was found, just to kind of understand what this table is doing or what it's for.
So we thought we'd illustrate an example of kind of how we think through our process as we go through. So in this example, we came up with a business that had pretty steady, solid growth on sales. You could see a 12.5% compounding annual growth rate. So just looking at this year over year looks great. So this is breaking it down by customer. Again, we're not expecting you to run through all this. It's more to give you an idea of what we're looking at. But you'll see customer 1 has kind of leveled off. Most of the other customers are showing similar growth. You have a new customer in 6. Nothing's really concerning so far at what we're looking at. Now, if you look at the blue bars, what you'll see in the last 6 months, starting really in March of 2017, customer 1, the blue bar, has completely dropped off. Now, interestingly enough, we made this presentation prior to COVID, but I think this is what we're going to possibly start seeing. And what this is it's not necessarily indicative of future sales, but it does draw a red flag out to be talking to management about why is customer 1 sales down. Customer 2 and 3 have stayed pretty steady. Will 2 take over for 1? Is 1 in trouble? Is 1 just going through a period where they have too much inventory and they're going to come back, or is 1 going to go away? So now if we flip to the next slide, which is the previous slide, there's a little more concern with this number we're seeing in customer 1 because they were on pace to do better in 17 and then it fell off a cliff. And then it furthermore makes us want to ask questions. Is 6 going to be customer 1's replacement? Was 6 a one-time customer that then is going to go away in the future? All things we're going to want to be considering as a buyer and even as a seller to prepare for questions buyers are going to ask us, so we have a story to tell on these customers and why we think there's value going forward for both sides.
Yeah, the overarching, and I'll talk about products in the next example, but the overarching discussion is, in addition to your financial statements, what's as you dig under the surface or scratch the surface deeper and deeper, what do you find, and how is that business functioning? How secure is the revenue, and what are the quality of revenues and what are the quality of earnings of that business? And half of most of the value is in the contribution margin and the products being sold or the services being delivered, and in the customer mix and who those customers are and how secure are they. So you have to really dig into more granular detail over a longer term than just looking at financial statements. And the deeper you go, if you just looked at annual customer revenue, you wouldn't have found the situation with the customers. So the deeper and deeper you go, the more you, as a buyer, you understand that business, or as a seller, you're understanding what questions that a buyer might ask you. So on the product mix analysis, this is just a similar type of analysis and understanding what those key products are, what those business services that you're selling are, what on a construction business, what the key contracts are, and how are they impacting margin. In this case, it looks fairly, consistent, especially product one has a little bit of a fall off. Maybe it has to do with customer one or one of the other customers specifically, maybe it doesn't. Then there's a ramp up in product two, and maybe that was the customer six situation. But as you go into, so it's fine to understand the sales side, but what is the contribution margin look like, and how is that impacting how that business is performing? Could be monthly, it could be annual, or on an annual basis you look at this, but you can see there's a small drop, or a drop, kind of deteriorating margin in product one, but everything else is relatively consistent. And the impact that has on earnings is, basically if you have a 3-point reduction in contribution margin in 2016, but just from a price variance perspective or a contribution margin variance, how does that impact even though you had higher sales on this page in that year, your actual contribution margin actually decreased. And then as you have less sales and lower contribution margin, you might not even be making up kind of the same as last year if you have deteriorating margins. So understanding margins by customer, understanding margins by products or distribution channels are all key considerations.
So next, what we do look at is not always just financial. We try and identify non-financial metrics that could indicate future performance. Here we have sales to web traffic. We've also done something similar with websites where it's sessions per conversion. So, if we're seeing an improvement in conversion rate on those sessions and it's continually climbing, it may still continually climb post-transaction. And it's something to keep in mind as a selling point on the sell side, but on a buy side, maybe some additional opportunity. Another thing, just another example of what we've used before in new home starts for the building industry has been a common one. So really trying to identify anything non-financial that might be a driver for future results. Now, as Kyle mentioned, the elephant in the room. So these are some of the ideas we've come up with talking about what we know so far. Impacts from COVID, I think the answer to this is we don't really know yet, but we can speak to it from what we're seeing at this point. And to cover that, deal stages, most of the deals we had that were coming to close in late March or were striving to the finish line, they did get across the finish line in April. Where we're seeing the biggest stall is in deal sourcing, or kind of that identifying targets that you want to acquire. And I think most of that comes down to the management meetings not being able to take place. Typically a buyer goes out to a target to meet with management, look at facilities, understand the process. And while it can be done via Zoom meeting or virtually, it's just not as successful as boots on the ground, face-to-face discussions about where the company is and where it's going. With that in mind, where we're seeing the money come from is we've been getting calls from private equities saying, we have capital to spend. Do you have any businesses going on in the market? So we're still seeing an inflow of private equities looking for deals to occur, whereas what's changed has strategics have pulled back a little bit. So industry players purchasing other industry players. We've noticed them focusing more on internal operations and their own cash reserves to make sure they stay okay, rather than going out there to spend. We do think that will change in the future as opportunities start to present themselves with the impacts of COVID on financials. and valuations for that matter. But at this point, we're seeing strategics stay a little bit more behind the closed doors. And I think part of that is also driven by understanding the environment and what the recovery trends are going to look like. And I think the big caveat to this is we don't see the overall deal space changing overnight to be one, the V, the U, L shape. We see it being very much industry by industry. I think some industries are going to see recovery sooner. Have clients that are probably more in the delayed U. They really haven't seen a drop yet, but they're anticipating some of the funding may fall off for a bit in the future. So they maybe haven't even seen the impact just yet. So that's why it's hard to determine exactly where that rebound is going to happen for every industry at this point. What we're looking for on the EBITDA adjustment side is really what I was talking about earlier. What businesses lost revenue because they could no longer produce, and what were the businesses that started producing different products that may be capitalized, but when markets start to correct themselves, they will go back to being the fashion designer in retail store. What's that one-time impact and the revenue disruption from this one-time impact? I think furthermore, we'll be thinking about cost structure changes with the unfortunate furloughing and letting go of certain employees. Are companies looking at this as trimming fat, or was it truly a cost-cutting measure? When they come back online, will they hire these individuals back, or are they going to realize that they're able to operate at a better capacity or more efficient capacity without those employees coming back? So understanding that going forward, and maybe historically projecting it back, saying, hey, our margin could have been, had we discovered this efficiency 2 years ago, could have been that much better. And with that's going to come some of the working capital trends too, where we see the initial indications are receivables aren't being collected as quickly. There's probably some risk for additional allowances that are going to be needed for companies that are cash strapped or paying on longer terms. Inventory and supply chain interruptions, days in inventory is probably going to change just because people are either panic buying or not able to get the supplies they thought. So where will that leveling out in working capital be? And then payables, we've run across a lot of businesses in this mid-range where they say, I get an invoice and I'm going to pay it as soon as I get the invoice. Well, can we extend those terms to be what we've already agreed with the vendors? We may have 30 days. Do we really need to pay it in the first 5? Can we use that cash elsewhere or make sure we're safe by keeping it in-house? Then finally, to touch on it quickly, the federal funding, PPP, and other loans that may be given, what will be forgiven, what's going to be the impacts of that, and just understanding as I was mentioning earlier, the payroll environment to the company post-COVID. Will it go back to what it was? Is it going to change? I think those are all questions we don't have great answers to yet. That's why Kyle was mentioning we'll probably do a presentation a little later summer once we start to see hopefully a rebound by then, so we could start quantifying these and giving more experience of what we're seeing. But since it's only been a month, we haven't seen as much come across in the financials just yet. Kyle, anything to add to this?
Inequality of earnings, because equality of earnings can basically smooth things out or kind of put a different veil or a different story behind the numbers than what actually happened. So how does that impact the earnings? And it'll be important to do equality of earnings in post-COVID to make sure any big dips in revenues that have subsequently come back up can be justified that they really shouldn't have been a dip. A pandemic of this nature happening, I don't know when the last one was, maybe was it 100 years ago or something. Obviously unusual in nature, and people buying businesses probably won't consider that to be usual. So, but it impacts maybe the valuation. So companies that experience more of a L shape or a U shape recovery versus a V shape, it'll be harder to justify the kind of smoothing out of revenue, because we're going to have data from pre-COVID, during COVID, and then post-COVID to really smooth out earnings and what a buyer can expect short and long term. So it could impact value, but it'll depend on the industry. It'll depend on how quick the recovery is overall, as well as for the industry. Timing wise, we're still doing quality earnings, specifically with companies that want to do kind of refreshes towards the end of 2020 and kind of go to market then. From a buy side, we just see that there's a lot of strategics out there that are maybe hoarding cash at the moment and maybe aren't quite as frothy on acquisitions. But there's still a ton of private equity money available to acquire businesses, and they might be more opportunistic with businesses that are experiencing a little bit of hardship. But we also think that baby boomers are sitting on a ton of these privately owned businesses, and this might draw them into thinking, now or in the next year or two might be the right time to sell, because this has definitely been stressful on those business owners. And then lastly, Frank already mentioned some of the considerations for adjustments, but it's really about trying to quantify how, if there was no COVID, or if COVID was not as deep, what would the numbers have looked like in a normal situation? So I mentioned we spent a lot of time working on EBITDA, and we'll probably spend the next 5 to 7 minutes on working capital before we wrap things up. On working capital, I mentioned that it's another value driver, and I would argue that working capital is probably the last thing that everybody worries about, and then it causes the most stress to everybody during the process, because it is one of the final things that sometimes gets negotiated leading up to closing, and then there's a potential for disputes and value after closing that can negatively impact sellers, or where buyers are trying to take advantage more of sellers. So making sure you have a good trusted team on working capital is important, and really it goes into the nitty gritty of understanding what's in the balance sheet, what is normal, what's being acquired, what the definitions are in the purchase agreement, any seasonality to that business. And I'll provide an example later on seasonality, and then what the post-closing adjustment period is, because you kind of have 3 pylons. And the first pylon is basically just setting the target based on what's in the balance sheet and what the normalizations are. Then you have what the closing balance sheet is, and there's a true up there that happens, positive or negative to the sellers, based on what the agreed upon working capital target would be. And then so that becomes the new pylon. And then post closing, oftentimes there's a true up period where the buyer actually gets to go in and figure out what actual working capital was, and then they get to true that up compared to what the estimate was at closing. So so you have to try to make sure you set the benchmark right from the get-go, and then the intermediary step is just a cash in, cash out potentially, or it's just an intermediary step. But setting the target correctly right away is super important.
Yeah, so we'll go through this one a little quicker. This is very similar to the EBITDA table we went through before. It starts with what we were given by management, and then what we're going to do is look for the gap adjustments, the inventory recognition we talked about, prepaid insurance and vacation accrual to build out to a gap working capital. Then what we'll do is we'll take out definitional items. So what we're thinking about here is a cash-free, debt-free environment. GAAP would say current assets include cash. Depends on how the deal is structured. A lot of them are structured on a seller takes the cash, pays off all their debt. So we'll adjust them accordingly with this next set of adjustments for credit cards, any accrued interest on debt, current capital lease adjustments. And then finally, we'll get to more of our normalization adjustments like we were talking about on EBITDA. Maybe they have not historically accrued bonuses, but they typically award them and pay them. So should we be considering that every month, that there should be a buildup that maybe isn't GAAP, but we're trying to make sure we set this 12-month working capital target, as Kyle was mentioning in the previous slide, to something that's realistic. So when the transaction occurs and we're looking back to true up working capital, we are doing it appropriately as to how it will be done going forward. And included in there is also things like related parties that may be buried within the subledgers of AR or AP.
Yeah, you want to basically, as a buyer, inherit a really clean balance sheet, one that you can basically grow the working capital for what it's going to actually grow and not be inhibited by, once these other things get taken care of and net out, what that balance sheet looks like. A couple of areas like, so credit card payables, if there's really, really long, like if they don't pay their credit cards ever, that's probably more like debt. But if they pay their credit cards, just an extension of accounts payable, that's maybe not debt, and maybe that doesn't get carved out of working capital. On the outdated payables, why would you as a buyer want to pick up payables that are 120 days or a year overdue or things like that? You'd rather have the sellers pay those off in advance. And basically from what's reported net working capital down to the adjusted net working capital, this would be, using the June 17 trailing 12 months, this would be about a $560,000 value driver, kind of all in, and how it would impact somebody buying that business. Understanding seasonality a little bit. If you buy during, if you assume you're going to use a trailing 12 months, which is most often, especially with a high growth business or with a kind of a moderate growth business or a company that's really seasonal, then there's cash that's going to change hands unless you time it right at the kind of midpoint of when the transaction happens. Because if you use an average trailing 12 months, it's usually either going to be higher or lower than the actual working capital in any given month. If the target, assuming is the average, is during the high season, like in March 16, then there would be the actual spot would be high compared to the target, and the sellers would receive additional proceeds because they don't have the cash sitting on the balance sheet, versus in the trough, they have a ton of cash sitting in the balance sheet, or their line of credit is really low, and so they have to actually help fund additional working capital to get them back to the midpoint, is how we usually see it. So understanding how that works is important. And we'll probably have I think we have a webinar coming up later this summer or early fall just on working capital. And I think I coined a 6-step keys to negotiating working capital. So if you want to plug in for that, that'd be great. Just to highlight some tax considerations, we have discussed some of these already, and Frank and I aren't the tax experts, but we have those in-house. But these are the key items that you want to definitely consider that can impact value and success of a deal, especially negotiating an asset versus a stock deal, and the fallout from that on what types of implications there are on success, reliability, and value.
Okay, so this is our last slide. What we're really trying to get at here is helping you overcome risks and findings using the toolbox we have available. And I want to keep this a little short so there is some time for questions if we have them. But we've talked a little bit about helping set EBITDA and working capital targets over time, and then just creating the definitions that should go into those. And that's really where we could be of the most value. But we can also help with definitions on the asset purchase agreement or stock purchase agreement, and recommending language for things such as reps and warranties, making sure such as GAAP-based financial statements are part of that definition so a buyer can't come in and redefine what it is. We really want to button up a lot of that language in these last agreements. There's a lot of deal fatigue setting in by the end when a lot of these are coming up, making sure to help keep it clean ahead and making sure you're covered post-transaction. So with that, Kyle, anything to add to this slide, or should we just move on to questions?
No, I think we'll go on to questions. I don't know, Amy, if there's any that have been coming in or not.
There's nothing in there right now. If you guys would like to submit a question, you can use the Q&A box located on your menu bar, or you can use the chat feature.
Well, we're hopefully getting some questions. I want to thank everybody for coming in today. Hopefully everybody's healthy, and if you're working from home, the kids aren't clawing at your legs at the moment. But be healthy, and I'm sure we'll come through this at the other side, and businesses will be functioning well again.
All right. Well, there are no questions at this time, but if you do have any, please feel free to reach out to Kyle or Frank. We hope everyone has a great day. So thank you, Kyle. Thank you, Frank.
Thanks, everyone. Stay safe.